All right, welcome to the special live stream session. Amanda, am I super fired up to talk about the Federal Reserve's decision today on interest rates. And we are less than 30 minutes away from the announcement at 11 a.m. Pacific Standard Time, and that's 2 p.m. for you guys on the East Coast. And it sounds like my audio is working great. So let me go ahead and turn that off here. And just so you know, this is also being live streamed in my private group. So if you're interested in joining a community of like-minded investors, you can check it out at firesidechat.com/community. And we have a lot of great discussions in there. Now, stick around after the announcement because Jerome Powell is scheduled for a press conference at 11:30 a.m. Pacific time or 2:30 p.m. Eastern Standard Time. And right now, the market is completely flat. They're all just waiting for that decision right now. NASDAQ is down about 0.5% and S&P 500 is down about 0.1%. And Dow is gaining some momentum here at about 0.5% gain or 233 points. And let's be honest, there's been no shortage of drama lately. We've been seeing this back and forth and this little soap opera between the Trump administration and the Federal Reserve. And you had Trump visiting Powell at the Federal Reserve construction site, which was a sight to see. And then you have the federal court ruling temporarily that Trump did not have the jurisdiction to, well, that was the ruling to, what was it, to tell Trump that, hey, you do not have the jurisdiction to fire Lisa Cook. And she was at the FOMC meeting yesterday, and it has been a bit of a circus. So with all that as the backdrop, I am very interested to hear what Jerome Powell has to say about today's decision. And this is going to be a monster live stream. I'm going to be live streaming for about 2 hours. With the first 30 minutes, I'm going to talk about what's going on with the labor market. And then at 11 a.m. or in about 27 minutes, we're going to see what the Federal Reserve's decision is going to be. And then at 11:30, we're going to get that press conference from Jerome Powell. So that's going to be very, very important for all of us to watch. So stay tuned. Anyway, personally, I think today is the day. And I think the Fed will finally cut interest rates. And I know some people are still on the fence, but that labor report that dropped over a week ago, it was pretty ugly. And I think it's more than convincing enough for the Fed to finally pivot and start cutting. And the big question on everyone's mind remains the size of the cut. Are they going to surprise us and rip the Band-Aid off with a 50 basis point cut? Or are they going to play it safe with the expected 25 basis points? And we're going to find out together in about 25 minutes. And I've been saying this in every single live stream since the beginning of this year that they should have cut interest rates way before. And I'm not trying to take sides on the political spectrum ever. I never do. But the labor report, when it first came out at the beginning of this year, it started to show some weaknesses. And I'm going to show you that too. And the manufacturing sector has been in a recession for a while. And that's something that should be alarming to the Federal Reserve. But they have been focusing on that 2% inflation target. And I think they're going to drop that target for this year and maybe next year and just say, we're going to keep it above 3%, right? Right now, we're approaching 3%. So we'll see what happens from there. But anyway, and before that happens, I'm going to look back at where we were. Let's pull up the last, here we go, the last summary of economic projections or SEP. So this is from June. And for those of you who might be new to this SEP is basically the Fed's consensus and predictions for the economy. And they put one of these out about 4 times a year, not about 4 times a year. And it's in March, June, September, and December, which gives us a peek into their thinking, showing us their forecasts for things like economic growth, unemployment, and inflation. Now, looking back at that June report, what you're looking at right now, the Fed has been signaling a total of 2 rate cuts of 25 basis points for each for 2025. And that was the game plan since their December 2024 meeting. When the new SEP comes out in a few minutes or in about less than 25 minutes, we'll get to see if that plan has changed. We will find out how many cuts they're now projecting for the rest of 2025 and what they're scheduling for 2026. When we get another SEP in December, we're going to find out how many rate cuts they're looking to do in 2026. And I'll be going live every time the Federal Reserve meets in the future. So be sure to subscribe if you haven't done it already. So let's talk about GDP, and which is the growth of the economy. And back in June, the Fed was predicting an annualized growth of just 1.4% by the end of this year, 2025, and ticking up slightly to 1.6% by the end of 2026. But before you think these are roaring numbers, they're not. And it shows the Fed was already expecting things to be a bit sluggish. And when you see the new report today, you're going to see these numbers at the bottom and see these numbers at the top. And I'll show you the numbers on top of the hour. Then there's the unemployment rate. And this one is particularly interesting given all the recent jobs data we have been getting. And if you've been following my channel for a while, you know I've been warning about the labor market for months and how it's much weaker than the headline numbers suggest. Well, the last SCP showed the Fed expected an unemployment rate of 4.5% in both 2025 and 2026. And we're currently at 4.3%. So we're getting dangerously close to their year-end target already, and it's only September, right? And don't be surprised if their projection increases to 4.6 or 4.7% for 2025 and 2026. If the unemployment rate gets worse, the Fed could have an emergency meeting to cut interest rates faster. And the last time that happened was in 2020 when the whole country or the whole world shut down for the COVID-19 pandemic. And of course, we have to talk about inflation, and specifically PCE inflation, which is the Fed's preferred measure. And the last SCP in June had them predicting or projecting an annualized inflation rate of 3% by the end of 2025 and cooling to 2.4% in 2026. And if I have to take a wild guess, 2025 is going to go to around 3.2 or 3.3%. In 2026, it's going to be around 3%. And we'll see what happens when the new report comes out. And it's no secret that inflation has again gotten hotter in recent months. And there's a good chance that the Fed will stop the 2% inflation target in the coming years. And Jerome Powell might even say that in the press conference today. Now, let's move on to everyone's favorite piece of abstract art, and that's the FOMC dots or the dot plot. And if you've never seen this before, it is pretty simple. Each dot represents what one of the Fed members thinks the federal funds rates should be at the end of the year. And it's an anonymous poll, so we do not know who is who, but it gives us a visual of the consensus or lack thereof within the committee. Now, looking back at the last plot for 2025 that came out in June, and this is the one that you're looking at right now, the dots showed a Fed that was pretty split. And you had about half the members wanting to keep rates up between 4% and 4.5%, but the other half wanted to be more aggressive with cuts, dropping the rates down into the 3.5 and 4% range. And for 2026, the dots showed a cleaner path. And let me show you this. Yeah, a cleaner path towards lower rates. And only one person, one lone wolf, voted to keep rates above 4%. I'm sure that person is probably going to change his mind. Excuse me. And the overwhelming majority saw rates falling somewhere between 3% and 4%. And as soon as the new report comes out on top of the hour, I'm going to take a screenshot of that and put it right up here on the screen so we can compare the old and new side by side. Okay. So let's take a look at this for the Fed Watch tool here. So this is, that's what let me scroll this down. All right. So that's what the Fed was thinking. So, but what does the market think? Let's jump over to the CME Group's Fed Watch tool, which is what I'm showing you right now. This tool analyzes futures contracts to calculate the probability of a rate hike or cut, right? And as for the meeting today on September 17th, the market is overwhelmingly predicting a rate cut that will bring the target down to 4% to 4.25% range. And here's the thing. There is a 4.2% chance priced in that the Fed could drop it by 50 basis points. And that's not a huge chance, right? but it's not zero. And it's all because of that weakening labor report we're going to dive into. And looking ahead for the October meeting on October 29th, the market is giving it an 80%, I'm sorry, 70% chance that the Fed cuts again down to a range of 3.75 and 4%. And we have 3 meetings left in 2025, and there's a real possibility we see more cuts, and especially if the unemployment rate keeps creeping up towards that 4.5 or 4.6% mark in the next couple of months. And by the end of the year, at the December 10th meeting, there's a good chance we could see another 25 basis point cut and ending 2025 in the 3.5 to 3.75% range. And the big fear and the argument from the hawks is that if the Fed cuts, if the Fed cuts too much too fast, we risk reigniting inflation. And believe me, after the nightmare of 2022, the last thing anyone wants is another 9% in inflation, right? And many items and services are still higher than what they should be if 2022 hadn't happened. But could the Fed really change its mind today? Okay. Now, maybe they'll surprise everyone with a 50 basis point cut. And I think it's a real possibility, actually, even with a just a 4% chance. And let me show you why. And take a look at this latest job or labor report revision from the Bureau of Labor Statistics, which shows the number of jobs created from April 2024 to March 2025. And that those jobs were slashed by a staggering 911,000 jobs. And most of that was during the Biden administration, but 3 months of that were from the Trump administration. And originally, we thought the economy was adding about 147,000 jobs a month, but the new data shows it was closer to 71,000 jobs on average. And that's a huge difference, and it's a game changer. It suggests that the Fed's current interest rates might be too high, and they need to lower them to help the struggling labor market. And both politicians and economists are weighing in, and the White House is piling on the pressure with Press Secretary, Caroline Levitt, saying Fed Chair Jerome Powell has officially run out of excuses and must cut the rates now. Even PNC Financial Services Group Chief Economist, Gus, agrees, noting that the revisions are clear evidence that the job growth was not as strong as the Fed believed. And the largest cuts to jobs were in the leisure and hospitality and professional and business services sector. And the healthcare sector is beginning to see some cuts as well in 2025. And it does not stop there. And let's look at the JOLTS report that came out a few weeks ago. The JOLTS stands for Job Openings and Labor Turnover Summary. It's a critical piece of data because it helps us measure labor demand, how many companies are actively looking to hire, and the unemployment rate, on the other hand, measures the supply of labor, right? And for a healthy market, you want a good balance. The JOLTS report gives us a much clearer picture of the real health of the labor market. And for the first time since April 2021, there are now more unemployed Americans than there are jobs available. And the latest JOLTS report from the Bureau of Labor Statistics just dropped a bombshell showing that the ratio of job openings to unemployed workers fell below 1, hitting 0.99 in July. And this is not because of a surge in layoffs. Instead, as one economist put it, the real issue is a decline in job openings. And this makes it harder for people to find work once they're out of a job. And even if they're not getting fired, this new data immediately fueled investor expectations for a Fed rate cut in September, with traders now seeing a 100% chance of a rate cut, right? However, some economists are pumping the brakes on the doom and gloom, arguing that this is a slowing of the labor market and not an imminent downturn or recession. They point out that the cooling is happening gradually, not all at once, like a typical recession. And plus, labor force participation has also been declining, which helps balance out the worker to job ratio. But still, all eyes are now on the upcoming September jobs report, which is the one that will really decide the Fed's next move. at the October 27th FOMC meeting. Now, and this all leads us to the unemployment report. And the headline for the unemployment rate now stands at 4.3%. And that's a clear sign that labor market is continuing to weaken. But the really shocking number here is August only added a mere 22,000 jobs. For an economy of our size, that is basically zero. But it gets worse when you look at the revisions. The BLS revised July's number down from 79,000 to 73,000, a loss of 6,000 jobs. The revision for June was even more brutal, with a net loss of 13,000 jobs from the original report. And when you add it all up, these new revisions show that the US economy has created fewer than 30,000 new jobs over the past 3 months combined. And economists are also saying this confirms the labor market is basically headed off a cliff edge. And on the bright side, this has sent a clear message to the Federal Reserve. And traders are now, again, they're pricing in for a 100% chance that the Fed will cut interest rates today. And while the majority of bets are on a 0.25% cut, the possibility of a larger cut is not off the table. And the report gives the Fed a strong reason to prioritize the labor market over its inflation goals, especially with a 4-month losing streak in manufacturing jobs. So while the job numbers are bleak, they might just be the catalyst for the Fed to act and provide much needed relief to the economy. Remember back in 2008, 2009, the global recession, right? How long did it take the US economy to drop the unemployment rate to drop from 10% at its peak all the way down to 4%? It took all the way to 2017. So just keep that in mind when people say, well, the unemployment rate is not a big deal. It takes so much longer for that unemployment rate to recover back to the 4%. Okay. Now, anyway, let's talk about inflation just for a little bit because it is a factor here, right? Because this was the big piece of data before the Fed meeting. And core inflation, which is prices excluding food and energy, came in at 3.1%, exactly the same as July, month over month. It was steady at 0.3%. And on the headline side, inflation ticked up a bit to 2.9% and 2.7% the month before. And the monthly came in hotter at 0.4%. So yes, inflation is still sticky, but it is not spiraling, right? And what this really means is that the Fed has room to cut, but probably not enough to justify a big 50 basis point move. In other words, this locks in a 25 basis point cut as the safer bet, because while inflation is not crashing, the jobs data is weak enough to force their hand. Okay. So what does all this mean to everyone, including you and me? And for the stock market for the rest of 2025 and looking into 2026, if the Fed starts cutting rates, the market will likely start pricing in even more cuts down the road. And who benefits the most when interest rates are low? Small cap stocks, right? In 2020, when the Fed funds rate was at zero, small cap stocks absolutely crushed the S&P 500. When money is cheap to borrow, investors get more comfortable taking risks and they become more what we call risk on, and that money flows into smaller, higher growth companies. And it's not just the stock market. And I forgot to show you this real quick. Let me go back to this real quick here. I want you to think about the housing market. A rate cutting cycle could be a huge tailwind for home builder stocks if it can attract more buyers. And let me ask you guys a question. With mortgage rates where they have been since 2023, around 6.5 or even 7%, would you buy a house right now if rates dropped to 5%? You probably would, right? And how many homeowners who bought a house in the last 2 years would jump at the chance to refinance from 6.5 down to 5%? Almost all of them. And I'm not saying the rates are at 5% right now, but I'm just giving you a hypothetical scenario. And almost all of them, if you think about it, it would put hundreds of dollars back in their pockets every month. Would you build a new house if you could get a loan at 4%? And I know I would. So, but keep in mind, and the mortgage interest rates may not necessarily drop based on the Federal Reserve's decisions today, okay? Because they do follow the benchmark based on the 10-year Treasury note. And I will talk about that later on, and I'll show you that chart later on if I have time. So, but looking at the rates today, right now, according to the latest data, right now, the 30-year fix is at 6.13%, and the 15-year is at 5.41%. And this is a significant drop from these levels. It would surely bring a lot of people off the sidelines, right? And all you have to do is just look at the 10-year Treasury and see how the yield drops, because that's how the mortgage rates follow their interest rates, okay? So how much time do I have? I have 9 minutes. So, with all this going on, what am I doing as a fire investor? And my strategy does not change based on one meeting. And I always make sure to have a healthy cash position just ready to deploy to the stock market. So if we see a market panic or a crash like we did on April 2nd for that Liberation Day event, I want to be a buyer, not a seller. And I am constantly dollar cost averaging every single Friday, like clockwork. And money goes into the market. I don't care if the market is at an all-time high or in a drawdown. A set amount goes into my 401k, my HSA, and my Roth IRA, and my taxable brokerage account for my early retirement. The only debt I have to my name is my mortgage, and it's going to stay that way until I'm ready to retire. And I've been down the debt road before, and I once had over $110,000 in total consumer debt, including credit cards, car loans, the whole work, right? I paid them all off back in 2015. December 21st, 2015 was when I became debt free. So over 60% of my income has been going into my investments, because I wanted to raise my savings rate to achieve financial independence faster. But I managed to claw my way out of that hole, and I'm never going back. And I will never take out a personal loan, I carry a balance on my credit card, or borrow against my 401k ever again. I'm not going to use a firm for that buy now, pay later crap that they have going on. That is probably one of the worst products out there. And people are just getting into debt left and right. I used to have a spending problem, and I probably still do, but I am much more responsible with my spending now. But with the interest rate cut today, it's not really my focus on how I am going to shift my financial independence strategy. My focus now is on paying close attention to the Fed funds rate and looking for opportunities to invest in sectors that are underperforming. So, do I invest in individual stocks? Absolutely. I'm always looking for another opportunity to gain not just 20%. I want 50%. I want 100%, or even 200%. I have individual stocks that have performed 200%. And I look at it and I'm like, man, should I sell? But I look at their fundamentals and their company earnings. I'm like, I can't sell this because it's so cheap, right? But that's how I can truly win and retire early with a savings rate of 60%. Okay. Now, just real quick, with less than 5 minutes, I do want to show you this, and so that you know what to expect going forward after this meeting. All right. So here are the important data points I want you to watch between today and the next Federal Reserve meeting. All right. So the next one is going to be on October 29th. The next big inflation data for the Consumer Price Index, or CPI, will drop on October 15th, followed by the Producer Price Index, or PPI, on October 16th. So weird to say PPI, just funny to say it. But anyway, then on that same day, we get the retail sales report, which will give us a read on the health of the consumers. And the next week, on September 25th, we will get the third and final estimate of the Q2 2025 GDP. And we're not going to get the first look at the Q3 GDP until October 30th. So which is the day after the next Federal Reserve meeting. And on September 26th, we get the next PC inflation reading. And this is the one that Jerome Powell and the Fed watch most closely. And don't be surprised if this comes in a little hot, maybe pushed up by tariffs or other supply chain issues. And I'm guessing we could be looking at 3% inflation at a minimum by the end of this year. Then on September 30th, when we talk about the JOLTS, look out for that JOLTS report, which is short for Job Openings and Labor Turnover Survey, or summary. Okay, so keep an eye on that. That's gonna tell us how many job openings are out there and how many people are quitting and how many companies are hiring. Pair that with the unemployment rate, which measures the supply side, basically how many people are looking for work, and you get a clearer picture of the job market's health. And finally, the big one, which I'm already showing you right now, that's the next unemployment report will come out on October 3rd. Right now, as we have said, the rate is at 4.3%. But if that number starts to creep up to 4.5 or 4.6% or even higher, you can bet the Fed will be pressured to act and act decisively. We'll see. But remember, even a 0.1% move in that rate represents hundreds of thousands of jobs. Okay. And the next FOMC meeting in October will decide whether to cut interest rates or hold them steady. And the current rate right now is 4.25 to 4.5%. In just a few minutes, we're going to find out if they're cutting by 25 basis points or surprising us with 50. If I had to place a bet, a wild guess, I think the labor data is so compelling that they might go for the bigger cut. And 4% chance. All right. I'm going to say they cut to a new range of 3.75 to 4%. And we'll see what happens. I'm probably going to be wrong on this. I'm most likely going to be wrong. And I'm probably going to be wrong about this and only cut rates to 25 basis points. So here's where we stand, right? Inflation is still too hot for comfort, and it's not coming down fast enough. At the same time, the labor report is looking weaker than we thought. And with almost 1 million jobs wiped out in revisions, unemployment creeping up higher, and job growth stalling, the markets are already betting on a series of cuts through the end of the year. And today's SEP and dot plot will show if the Fed is finally ready to admit that reality. So what does that mean for you? Lower borrowing costs, better chance for housing, possible tailwinds for stocks, and more volatility in the months ahead. Bottom line, the Fed's decision today is not just about Wall Street. It's about how your money, your job, and your future could be shaped heading into 2026. All right. So I am going to live stream Jerome Powell later on at 11:30. So stand by for that. And they're about to make a decision in about a minute and a half. Let me go ahead and pull up Bloomberg here. Bloomberg. And there we go. Make sure I unmute that.
Look at where we were. The projection was for 4.5% at the end of this year in terms of an unemployment rate and a 3.1% core PCE. It wasn't expected to shift that much on either front over the following couple of years.
John, I think that's a really, really important point. What confidence do we have in our guesses out to June of next year?
I'll tell you, I remember when my HYSA high yield savings account was like 0.9% or 0.8% back in 2019. So, half of America, I don't think it's going to come down that much anytime soon. But
this is the question I think
maybe one day we'll see that again
today. And for the news conference too for Chairman Powell. And there was a key difference between how he addressed this question in July and how he's thinking about it over at Jackson Hole in August. What is anchoring your view?
The Federal Reserve website is already crashing. That's hilarious.
Because the Chairman Powell of July was very different to the Chairman Powell of August,
who said that it was really important back in July to look at the unemployment rate and then the payroll's headline figure. The problem is right now, people really dispute the idea that we have the same kind of labor market that requires the 150, 200,000 jobs created per month, and that this is more of a 50,000 a month kind of break-even rate that we should be looking at.
Do you get lulled into a bigger conversation, a bigger decision than you otherwise would have made? And that's something that this Federal Reserve has to confront today and for the next several months. That decision is 20 seconds away. The question is not if they'll cut interest rates. The question is by how much, 25 or 50, and how much can you project in the guidance, the forecast. Equities going into it just about unchanged in the S&P 500. In the bond market, 2s, 10s, 30s.
They cut 25 basis points down to 4% or 4.25%. I'm going to read the statement in a second, but they're about to make that announcement.
The answer to your question, John, is a 0.25 percentage point cut as expected, but Fed officials also see 2 more cuts this year in October and December, according to the new dot plot. There was one dissent, and that is from Stephen Myron, the Trump representative on the board, who wanted no cuts this time. He wanted rather 2 cuts this time, 50 basis points. Next year, the committee sees only one cut so far, but the dispersion is very wide. And the very bottom dot for next year is at 2.75%, suggesting once again that is Stephen Myron. The committee sees that the risks to that they are attentive to the risks of both sides of their mandate, but they say the risks to the downside for unemployment have increased, and that's the reason that they are cutting rates today. They also adjust the forward guidance in the statement to drop the word extent and just say in considering additional changes to the target range in the future, they will consider all kinds of options. There is no real change to their economic forecasts, but we don't know exactly why that is, whether it's because Myron contributed different numbers than others, or Anna Paulson, the new Philadelphia Fed president, contributed different numbers than others. But the growth rate is marked up for this year to 1.6% from 1.4%, and the unemployment rate is unchanged at 4.5%. PCE inflation at 3% is unchanged from their July forecast, and core PCE inflation unchanged at 3.1%. There's no change overall to the balance sheet, and once again, there was one dissent, Stephen Myron, the new member of the board from the Trump administration. The rest of the board, including Mickey Bowman and Chris Waller, satisfied with moving the rate down to the range of 4 to 4.25%.
Mike McKee, thank you, sir. Stay close. We'll take some time to internalize what we've just heard from the Fed.
Yep. So I'm pulling up the statement right now in the summary of economic projections. So I'm going to put that side by side in a second here.
Lower at the front end of the curve, down by 2 basis points on twos to 348. And foreign exchange, some euro strength, some dollar weakness. We approach 119 on euro dollar, which is its own story, which we'll get to later, 118.84. I want to do a couple of things. Let's take the forecast and just focus on 2025 and 2026. And I just want to focus on where the projections were in June and where they are now. And just go through this piece by piece. For GDP, compared to June, that's an upgrade for this year and for next year. For the median dot, we've gone from 3.9 in June down to 3.6 for now. So we're looking for another 2 cuts. For next year, we've come down from 3.6 to 3.4. And PCE has remained pretty stable, I've got to say, for this year. For next year, they're looking at around 2.6%, up from 2.4. So just get into this a little bit more. What an odd decision we've got here, Bramo, that this Federal Reserve, and you don't usually see this, has cut interest rates by 25 basis points, has increased by just 1 interest rate cut relative to where we were in June for this year. At the same time, they've upgraded growth, kept unemployment basically unchanged, and basically projecting CPI to be sticky and close to 3%.
And saying in their statement that inflation has moved up and remains somewhat elevated, as their SEP, their Statement of Economic Projections, suggests. So then why is the bond market rallying? Why are yields down, even at the long end, if this is basically the projection that inflation will remain high and they will cut into that inflation? And what this hints at, and this I think is really going to be interesting, is this clear desire by the Federal Reserve to overweight the economy, even allowing inflation to run hot, and they will keep cutting despite that inflation. That is what is getting translated into this market.
I want to cross back over to Mike McKee if he's still with us and hasn't run off to the news conference just yet. Is Mike there? Good. Mike, I want to come back to you. How original is to see this, to see a rate cut, to see the projection of more to come, at the same time all these other things are happening with the forecast? How can you explain that?
Well, I think there's 2 possibilities, and they both center around the new members on the board, Anna Paulson from the Philadelphia Fed, and most probably Stephen Myron. When you look at the range of the forecasts for GDP, they moved up the bottom range and the top range, and the same is true with the unemployment rate. It didn't move at all, but inflation didn't move. And it seems that Myron probably put in stronger growth, lower unemployment, and at least unchanged or lower inflation going forward. And that probably accounts for the changes in the forecast. What's really interesting is the wide dispersion in 2026 dots. There's clearly no consensus yet on how many rate cuts they're going to want to see, except Mr. Myron thinks rates will go down to the 2.5% to 2% range.
Mike, we're not going to find that out until the next SCP comes out. So let me show you what they just released here. Let's see, is this the one? Nope, that's it. Okay, so let me show you this on the comparisons, all right? So This is the what Bloomberg was just talking about right here for the real GDP. Right now, it's projected to increase to 1.6%. The previous one at the bottom you see this is 1.4%, and in the 2026, it's projected to go up to 1.8% from the 1.6% projection. Unemployment rate is unchanged. That's what Bloomberg was just talking about right here at 4.5 to 4.5%. And next year, they're thinking that the unemployment rate will go down to 4.4%. Okay. So they're very optimistic about the labor market, probably more than most people, even me. So PC inflation, they're thinking that this is going to remain the same at 3%, which is a head scratcher for many of us. And then the core PC inflation at 3.1%. And they think that the PC inflation for next year in 2026 will be higher at 2.6%. And this is what I was talking about. So now this is down to 3.6 to 4.1%. So we have two Federal Reserve meetings remaining, right? Let me change my screen here. So they're thinking that they're going to cut two more rates, or they could have a bigger rate cut in October, or it could have a bigger rate cut in December. This is all going to be data dependent. That's what Jerome Powell is going to say. This is going to be very data dependent. And the other thing that I did look at, this is the side by side on the June SCP, and this is on the right side. That is the SCP from today. All right, summary of economic projections, and the next one we're going to get is in December. It comes out 4 times a year. So over here, I just try to line them up as much as I can. So most Fed members moved down to 4 to 4.25%. So they're still kind of hawkish as far as how they still want to maintain their interest rates higher. So that's a 4.25%, 4 to 4.25. But the majority of the committee members want to cut rates. You see the rates cutting down to 3.5 to 3.75%. So based on the data that we're getting right now, they're looking to cut rates by 25 basis points today, which you already did, and then another 25 basis point rate cut in October, and another one in December. So that brings it down to 3.5 to 3.75%. So that's kind of what this means when you look at it. Now, as far as the statement goes, you go to federalreserve.gov, and then you can look at the statement. This is what Bloomberg was talking about. So the committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. Uncertainty about the economic outlook remains elevated. Let me go and zoom in. Sorry about that. I'm blind too. And the committee is attentive to the risks to both sides of its dual mandate and judges that downside risks to employment have risen. In support of its goals and in light of the shift in the balance of risks, the committee decided to lower the target range for the Fed funds rate by 25 basis points, or a quarter percentage point, to 4 to 4.25%, in considering additional adjustments to the target range for the Fed funds rate. The committee will carefully assess incoming data, which is all the data that I went over earlier, right? If you go back, or I'll just go back to it. And if you go to this part, these are all the data that the Federal Reserve pays attention to: inflation, retail sales, GDP, PC inflation, jolts, unemployment, right? And that's all going to come out on September 30th, which is 2 weeks from now. And then unemployment comes out on October 3rd. So if you want to mark that down on your calendar to find out what's going to happen. Anyway, the committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities. The committee is strongly committed to supporting maximum employment and returning inflation to its 2% objective, which is like in every announcement. In assessing the appropriate stance of monetary policy, remember, Federal Reserve, they're in charge of the monetary policy, and then Congress is in charge of the fiscal policy. The committee will continue to monitor the implications of incoming information for the economic outlook. The committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. That makes sense, right? So again, if unemployment comes in hotter, say the next data on October 3rd comes in at 4.4%, or if it goes up higher at 4.5%, then there's a good chance that October 27 meeting, they could say, let's cut rates faster and more of a jumbo rate cut to 50 basis points, right? So that would be the possibility. Now, in about 20 minutes, Jerome Powell is going to speak, and we're all eager to watch him speak. But this is something that this is breaking news with the 25 basis point rate cut just happened. And you know what? I forgot to look at the live chat. Sorry about that, guys. Noah, wow. Thanks, man. You're going to Air Force BMT in November. All right. I was just there to watch my my niece's BMT graduation. And I went to basic training over 20 years ago. I just retired from the Air Force. So now, every Friday I make every Friday I do the TSP content, just like what to do, what to invest, and all that stuff, right? And on Mondays and Wednesdays, I usually make videos about the financial independence strategies or Roth IRAs or anything else. So I dedicate Fridays to just TSP stuff. So that's pretty cool, though. I appreciate you for your donation and your contribution to. Let me know what your AFSC is going to be. AFSC, if you don't know what that is, it means what job are you going to have with the Federal Reserve? Federal Reserve. What job are you going to have with the Air Force? I'm thinking about the Federal Reserve today. But let me go and pull up Bloomberg real quick. And I want to look at the market too. I want to see how the market is doing, especially Russell 2000. And let's watch some Bloomberg and see what they're saying.
This year seems a little bit aggressive. Look, to me, that is notable. And it might be exceptional for people to hear that and absurd if you think about it.
I will say, and this is my personal opinion, let me know in the live chat how you feel about this. I think we should have cut back in May when the jobs data came out really bad. And I said it back then, and I went live stream on it, and it wasn't really talked about on the mainstream media because the jobs data came out like okay, but I'm like, that data did not look good based on the climate. But yeah, I mean, they probably should have cut by 50 basis point rate cut. Let me know in the live chat how you feel about that. Like, they probably should have cut by 0.5%, in my personal opinion.
Correct.
What 26 brings, what 27 brings. Correct. This is a low conviction Federal Reserve. And you've got to bear that in mind when you go into this news conference. These guys are not gods. They haven't got crystal balls. They are clueless going into next year.
We're all clueless. And when we were speaking.
Yeah, I agree with you on that in the chat. I mean, the seasonal workers are going to come on live around October, November, December for the holiday shopping, right? For all the seasonal shoppers. If that data comes in weaker, right, and there's been a shift in the consumer spending, is people have been buying things online more than going to the stores. Because every time I go to the store, I'm disappointed because they're out of stock, or they're it's not on the shelf, whatever. But I go online, I can get those from Amazon for sometimes cheaper and faster. So we're going to see how that translates into like stores like Target, Walmart, when they start hiring those seasonal workers. Are they going to hire fewer people this year going around? If that's the case, that could be more troubling in the labor market. Okay, so we'll see how that goes.
Also, can we go on the edge of Myron? I guess that's the question. Can we find that dot?
I don't think you can get there without a recession, honestly.
Yeah, I agree with you, Armani. That's my take on it too, based on what I've seen.
The starting place is above neutral, right? So we're not even at the top of neutral yet. Yeah. So, the Fed still has room. They still can get to 4%, and they're neutral, right?
Noah, if you can't commission right away, I would commission. That's just my personal opinion. But if you want to enlist and then go, become a prior E, go for it, man. But that's awesome that you're going to become that client systems.
Neutral territory yet.
In some ways, this was the easy decision. And every decision after this gets a little bit harder. In equities right now this afternoon, equities rolling over on the S&P 500, so negative now by about 0.25%. Check out the Russell up by 1.24%. The rally for small caps continues. Bond yield still a little bit lower at the front end, lower at the long end. 30s are down by 3 basis points. 2s are down by almost 2 basis points. We've got Bob Michael at JP Morgan still with us. Bob, I want to come back to you. You've just heard from a Federal Reserve, and I don't know what we get in the news.
CME Group is now predicting 97.7% chance that the Federal Reserve will cut interest rates by 25 basis points on October 29th. And then on December 10th, they're pricing in a 93% chance that the Fed funds rate will go down to 3.5 to 3.75%. Wow.
I think they are going to cause greater growth and maintain stable inflation. Look, I think there are so many policies in flux on the fiscal side that we don't know yet. I think what we do know is that the labor market was starting to struggle by a greater degree than we all had thought. And we saw that revision and went, and it's time to start relieving some of the pressure on corporate America now.
John, it's 216. We've yet to mention tariffs. I find that extraordinary.
So I'm pleased you brought this up, TK, because I think still a lot of people are talking about the tariffs of April as an event and not a process. And I think it's far more important to be open-minded about the process and the potential of pass-through still to come. We know based on the data so far that we aren't seeing the exporters drop prices aggressively. You can see that in import prices. We know based on the data so far that a lot of companies domestically are absorbing this on margin.
Right.
What we don't know is whether they pass on those costs in the next several months and change this inflation picture entirely.
Exactly. And when I look at the Excel spreadsheet from the Fed here and the sub 2% growth, my question is, are we seeing a decline in purchasing power? And that's why you see, the curve coming down and yields coming down right now.
I think what we've seen, Tom, without a doubt, is that we've seen a massive step down in payrolls growth. That has clearly spooked some members of this Federal Reserve. But Lisa, I think it's key to point out, not all members of this Federal Reserve. There's some members of this Fed will still be anchoring their labor market view around what's happening with unemployment, which has been pretty stable through all of this, through the whole of this.
No, Trump has not released anything on Truth Social yet.
Around 4.5%.
Yeah, which is the dispersion. And going back to that is the reason why I'm struggling to interpret the move in markets right now. Because is the market taking their guidance on Myron or on the idea that there are Fed officials who are pushing back and saying, actually, we need to be tighter? Right now, is this a trial balloon for what it would be if there was a Fed that was being more aggressive? Or are we not there yet? I mean, that I think is going to be a tell in terms of, does the bond market behave if it believes that a Fed is...
Yeah, look at that. What did I tell you? Russell 2000 is up 1% already. The small cap is always going to be taking off when the interest rates start to drop.
Program. So much to process here going into this news conference in about 12 minutes time. What's your number one issue going into the presser?
Well, first of all, it's really clear that Powell corralled the cats, and I assume that Waller and Bowman did not dissent in part because of the strong retail sales data, which also revealed inequality and something else that's going on out there, and that is that spending on restaurants went up after adjusting for inflation. Spending at grocery stores actually fell after adjusting for inflation and the retail sales numbers. And so you've got this sort of, the K-shaped economy we keep talking about, the bifurcation, but that masking the underlying weakness in lower and middle income households. So this was clearly an acknowledgement that, yes, the labor market has weakened and they want to shore up the labor market. What surprised me,
the Treasury yield, 10-year Treasury yield just dropped to 3.98%. which is the first time since April 2025. So watch the mortgage rates start to drop too.
In the forecast. And I think that's important as well because they're removing restriction now. It's not just calibrating down because the neutral rate has moved down. They're trying to say, listen, we're removing some restriction, acknowledging the weakness in the labor market, want to shore up the labor market. But if you really do read this sort of through to next year with a major change in leadership at the Fed, you could have a situation where you overstimulate and get a more pernicious and self-fulfilling prophecy on the fact that consumers and firms now expect inflation to be higher. And I think what the Fed is struggling with is that consumers are also telling them in their own surveys that the job market's the worst it's been on record since 2013. That's something that has got to have startled the Fed as well.
Diane, this is without a doubt a very confusing economic time. It's also a very confusing time when it comes.
Yeah, 100%. The unemployment rate, I mean, I would say right now, I know it's showing 4.3%. I bet you it's probably a lot higher than it should be. So it's probably like it's already sitting at 4.4 or 4.5%. But the labor participation has gone down, and that's another reason why immigration and all that. That's a big factor too. So
more stagflationary over time. That was hard to forecast. It's another thing to live it in real time. And that's what we're doing. And unfortunately, it is very hard to not, you have to shore up the labor market a bit. That said, you don't want to remove so much accommodation that you allow these waves, as we heard earlier. I mean, the idea that these are an uneven rollout of tariffs, so it's not just one and done. And Powell was careful in his Jackson Hole remarks on that too. It's not all at once. It's coming in waves. That reinforces the idea that we're going to normalize inflation, which becomes its own self-fulfilling prophecy. And the Fed really has to be quite cognizant of that.
And Diane, you know, in the study of Michigan, Chicago, and down south down the Mississippi River, the mail I get is people are flat on their back in this K-shaped economy. How does Jerome Powell address the have-nots of America? They don't have AI. They didn't buy NVIDIA like John 3 years ago. What do we do with the people that aren't participating in the system?
Well, it's really the inequality is getting worse. We know that. Actually, Moody's just came out with an updated estimate on some of the inequality, and the top 3.3% of households are really doing really, really well. The top 20%. A little bit better in terms of gaining spending since 21 relative to inflation. The rest of the economy, the bottom 80%, pretty much flatlining it since after adjusting for inflation on their spending patterns. That's a really tough position to be in. And it gets to the heart of what we're still dealing with is the embers of the pandemic inflation. We're still smoldering when you added on the tariff-induced increases in prices. And that's what's really tough for the Fed to deal with and for the average American, because remember, even when the labor market was much more robust, when inflation flared, the majority of Americans believed we were in a recession because their purchasing power was eroding and they were losing ground. And I think that's very important because it really gets to the corrosive nature of inflation. And at the end of the day, you cannot get full employment sustained unless you really derail inflation. What we don't know is if this will just be a couple steps up and then just come off, or if it will be more persistent. And that's what he's going to have to emphasize at the press conference today, is that they're going to be mindful to watch what's coming on in terms of how persistent the inflation becomes and how much inflation expectations, to get jargony, get unmoored.
NVIDIA. That's my biggest position, TK, at Hindsight Capital.
You killed.
All right. So, 100%. The rich are always, they're getting richer. The poor gets poorer, right? And, I know there's always been an argument of, they're not taxing enough millionaires or billionaires and all that. I remember being at the bottom of pretty much everything. Like, if you guys have been following me for a while, back in 2013, I had like over $110,000 in consumer debt, and I was at that bottom, right? And I was making like less than $58,000 a year when I was active duty in the Air Force. What I realized, and just kind of like when I actually started doing a budget, and I'm not trying to tell you guys to do your budget because you guys already know this, who is watching this. When I didn't do any of that, I had no idea where my money was going. And when I talk to my clients and my private clients and people who schedule a consultation with me, and when I ask them what their monthly nut is, they don't even know what that is. Most of them don't, right? Because they're like, well, estimated I spent this much. Okay. So, this is how much money you would need to have invested with a pension to achieve financial independence and retire early. What you need to really, if you're at that bottom where you're still in debt, like I was I had $47,000 in credit card debt. I had $48,000 in car loan. This was 2013, by the way. And I had a personal loan for $10,000. I had a TSP loan. Where's that guy who's going to basic training? Noah, don't take out a TSP loan, please. When I took out that TSP loan, it was like $10,000. It was I had no cash flow. I had no room in my budget to invest or save or any of that. And what I also realized was that I needed that income to pay off the debt, but it wasn't because of my income that put me into debt in the first place. I had no control of my spending at all. I wasn't tracking them. I didn't know what I was doing. And I didn't, it's not even about how much I need to save and invest, but it was really about how much I needed to control my spending. I went out to eat every single day. I went out to drink every single night. Literally, that was in my 20s, right? And when it went out of control, when I started making bad life decisions, and if you watch my other videos, I talked about my divorce a little bit too. But I'm not gonna blame everything on my divorce. Divorce was like part of the reason, but that was one of the contributing factors to it. But the root cause of me getting to that $110,000 in debt was because of my spending problem and not being in control of my finances. So if you're trying to pay off your debt, no matter what the interest rates are doing, no matter what the Federal Reserve, Congress, or the Trump administration are doing, you need to take control of your finances first. Pay off your stupid debt. Pay off your credit cards. If you can't pay off the balance on your credit card every single month, you have no business owning a credit card. That was me. I maxed out 5 credit cards, $47,000 total, right? On average of almost $10,000 in credit limit. And I remember going over that limit, and I'm like, I don't know what I'm doing, right? And I just kept spending, and then made minimum payments, and I spent more, and just always maxed out. And so if you can't pay off your debt, like if you can't pay off your credit cards, don't own a credit card. The 0% interest transfer thing, that's also stupid too, right? That's like, I'm going to take out a 0% 18-month interest-free credit card, and I'm going to spend money on this, and I'm going to pay it off because I can make more money from the HYSA. I'm like, really? You still got to pay taxes on the interest that you pay, that you get from the high-yield savings account. So you're not including that into your calculation. So people are trying to find ways to, I'm going to borrow my way out of debt. It doesn't work. I tried that. I really tried that. I even took out a personal loan to try to pay off my credit card. It did not work. So when I spent 2 years of my life doing absolutely nothing just to make that sacrifice, that's 10 years ago. Now I'm looking back, man, I'm like, I am so glad that I have sacrificed 2 years of my life to pay off my debt. If you're in debt, please pay it off as soon as you can, because there's no way you can save and invest 50%, 60% of your income to try to retire early, right? If you're trying to retire early, you need to have a higher savings rate. It's going to be very difficult for you to achieve that 25% savings rate if you have a car loan and a car payment for $900 a month. I have seen some outrageous car payments for like $1,400 a month. I'm like, what? Why? It's not about how to pay it off, but you need to figure out that why. All right. Jerome Powell is going to speak in about a minute. So let me go ahead and pull that back up here. And I should probably unmute, huh?
So you should expect to see more dispersion. What the markets are trying to suss out, what I'm trying to suss out is what's real and what's political. And I think that's an open question, and time will tell on that front.
Is the political real?
Well, the political is driving the real.
They're going to be
saying Jerome Powell is very on time, unlike any other politicians or
this
any
is the world.
Public statements they're going to make. This guy is so on time,
and so it's not going to change anytime soon. But this was an incredibly dovish SEP and dot plot, and the market.
And I'm going to hide myself when he makes that statement.
For sure.
So I'll still be around.
Who that dot actually belongs to at the Federal Reserve? You can have a decent guess. Sure, they're not going to tell us. But here's my point.
I bet you $10.
It would be a mistake, I think, to say that's Governor Myron. It does not matter. Isn't that a hint, a flavor?
Yeah, he's probably going to speak for about 45 minutes to an hour
in 2026. Isn't that ultimately what the
he's going to take a lot of Q&As during the press conference after he makes the statement.
This is the reason why I do believe, based on the market activity, people are putting a disproportionate amount of weight on that dot and on the view, on the dissent, because it is a flavor of who that new Fed chair could be.
We're close to Powell coming out as quick as I can. The markets will police the politicians in Washington.
TK, you say that. Look at what this Fed's just done. It's revised higher its inflation forecast and just cut rates.
But we are, as he correctly said, Greg said, we're above the neutral rate substantially. They got wiggle room here.
This decision is the easier decision. Without a doubt, we're on the same page on that front.
Evan, you can always schedule a consultation with me. Just go to firesidechat.com/consultation, and then we can talk about that, all right? About the TSP loan to pay off your credit cards.
Jay Powell, who stepped into the room. Let's take a listen to the chairman of the Federal Reserve.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. While the unemployment rate remains low, it has edged up. Job gains have slowed and downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. In support of our goals and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by 1/4 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a pace of around 1.5% in the first half of the year, down from 2.5% last year. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles has picked up from last year's pace. Activity in the housing sector remains weak. In our summary of economic projections, the median participant projects GDP to rise 1.6% this year and 1.8% next year, a touch stronger than projected in June. In the labor market, the unemployment rate edged up to 4.3% in August, but remains little changed over the past year at a relatively low level. Payroll job gains have slowed significantly to a pace of just 29,000 per month over the past 3 months. Oof. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the marked slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. In our SEP, the median projection for the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 2.9%. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 3.0% this year and falls to 2.6% in 2026 and to 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by 1/4 percentage point to 4 to 4.25%, and to continue reducing the size of our balance sheet. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside. a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. With downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027. This path is 1/4 percentage point lower than projected in June. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Policy is not on a preset course. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Here we go. Q&As.
Great. Thank you. Chris Rugaber at Associated Press. As you know, Fed Governor Stephen Miron has kept his position at the White House, even as he's joined the Fed board. This is the first time, I believe, the Fed's board has had someone with executive branch ties in decades. Does this compromise the Fed's independence from day-to-day politics? And relatedly, how can you maintain the public's perception the Fed is politically independent with this dynamic? Thank you.
So we did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. We're strongly committed to maintaining our independence, and beyond that, I really don't have anything to share.
Okay, and then just as a quick follow-up, I'm sorry, can you and other Fed officials have spoken extensively about the impact of tariffs on inflation, although perhaps with many companies appearing to eat the tariffs, tariffs may be impacting the labor market and other parts of the economy instead. Do you see that as a possible outcome here, that tariffs are the reason we're seeing some slowing, particularly in the labor market, rather than in inflation? Thank you.
You know, it's certainly possible. You know, we're beginning to see, we have begun to see goods prices showing through into higher inflation. And actually, the increase in goods prices accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year. Those are not very large effects at this point, and we do expect them to continue to build over the course of the rest of the year and into next year. And you know, it's also possible that there may be effects on employment, but that I would say, if you're looking at why employment is doing what it's doing, that's much more about the change in immigration. So the supply of workers has obviously come way down. There's very little growth, if any, in the supply of workers. And at the same time, demand for workers has also come down quite sharply, and to the point where we see what I've called a curious balance. It's, you know, typically when we say things are in balance, that sounds good. But in this case, the balance is because both supply and demand have come down quite sharply. Now demand coming down a little more sharply because we now see the unemployment rate edging up.
Thank you.
Nick T.
Nick Timmerosa, the Wall Street Journal.
Call that.
Chair Powell, do economic conditions and the balance of risks no longer warrant a restrictive policy setting?
So I don't think we can say that. But what we can say is this: that over the course of this year, we've kept our policy at a restrictive level, and people have different views, but a clearly restrictive level, I would say. So, and we were able to do that over the course of this year because the labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, I can no longer say that. So what that means is that the risks were clearly tilted toward inflation. I would say they're moving toward equality. Maybe they're not quite out of equality. We don't need to know that, but we do know that they've moved meaningfully toward greater equality, the risks between the two goals, and that suggests that we should be moving in the direction of neutral, and that's what we did today.
Under what circumstances would a larger than 25 basis points rate cut be warranted? And how seriously was that option entertained at your meeting this week?
There wasn't widespread support at all for a 50 basis point cut today. You know, I think we've done very large rate hikes and very large rate cuts in the last 5 years, and you tend to do those at a time when you feel that policy is out of place and needs to move quickly to a new place. That's not at all what I feel certainly now. I feel like our policy has been doing the right thing so far this year. I think we were right to wait and see how tariffs and inflation and the labor market evolved. I think we're now reacting to the much lower level of job creation and other evidence of softening in the labor market and saying, well, those risks are maybe not fully balanced, but moving in the direction of balance now. And so that warrants a change in policy.
Colby Smith for the New York Times. Should we be viewing today's cut as the committee taking out some insurance against the possibility that the labor market is at risk of weakening? Or is it the committee's view that the dynamics of a downturn are already in place? I guess I'm just trying to square the shift in the rate forecast in the SEP towards more cuts than just 3 months ago, with the fact that the forecast for unemployment didn't change.
Yeah, I think you could think of this in a way as a risk management cut, because if you look at the SEP, actually, the projections for growth this year and next actually ticked up just a little bit, and inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market. You've seen, we were looking at 150,000 jobs a month at the time of the last meeting, and now we see the revisions and we see the new numbers. And I don't want to put too much emphasis on payroll job creation, but it's just one of the things that suggests that the labor market is really cooling off. And that tells you that it's time to take that into account in our policy.
So just looking at the SEP, once again, the median participant has inflation higher than previously expected by the end of next year, and the Fed not getting back to the 2% target until 2028. So I guess I'm just wondering how you characterize the risk to price pressures of kicking off a series of cuts at this point.
Yeah, so I would look at it this way. We fully understand and appreciate that we need to remain fully committed to restoring 2% inflation on a sustained basis, and we will do that. At the same time, we've got to weigh the risks to the two goals. And I would say since April, to me, the risks of higher and more persistent inflation have probably become a little less. And that's partly because the labor market has softened, GDP growth has slowed. So I would just say that the risks there have been less than one might think. And in terms of the labor market, what we're seeing is unemployment is still low. It's still a relatively low rate, but we're seeing downside risks.
Michael McKee from Bloomberg Radio and Television. I'm a little confused by your explanation of the Fed cutting rates because of unemployment. If you think that most of what's happening in the employment area is related to immigration, which your rate cuts wouldn't address, how do you see that as more important than inflation, which has remained almost a full percentage point above your target?
Well, I was saying that what's happening in the labor market has more to do with immigration than it has to do with tariffs. That was the question I was answering. So I wouldn't say that all of what's happening in the labor market is due to tariffs. I mean, you clearly have a slowing due to immigration. You clearly have a slowing in demand, which is now perhaps more than that in supply, and we know that because the unemployment rate has ticked up. So that's how it.
Somebody was putting in the live chat. No, I'm not censoring any chats. That's YouTube censoring or masking some of the words. So I can see them all on StreamYard, but I can't. You're not going to be able to see them on YouTube because I'm looking at the YouTube live chat and it looks like they do censor quite a few words on there. So just keep that in mind. I don't censor anything, just so you know.
Achievable, and does this present any credibility problems for you in telling people that that's what you're going to do if you can never reach it?
Well, I mean, you're right. It does say we're going to get to 2% inflation in 2028 at the end of 28, but that's literally how you put the projections together. You're writing down a rate path, which is designed to create over the course of the SEP, time frame, 2% inflation and maximum employment too. So that's all that is. No one really knows where the economy will be in 3 years, but the nature of the exercise is to write down policy that you believe would return to the 2% goal over at least by the end of the exercise.
Thanks so much, Elizabeth Schulze with ABC News. The latest inflation report shows that prices are still going up across key categories for many households, including groceries. What will the Fed do if prices pick up more?
So our expectation, and you can see this consistently through the year, has been that inflation will move up this year, but that the effect, basically because of the effects on goods prices from tariffs, but that those will turn out to be a one-time price increase as opposed to creating an inflationary process. That's been our forecast. Pretty much all the individual forecasts say that. We can't just assume that though, right? We have to, our job is literally to make sure that is what happens, and we will do that job. Right now, the situation we're in is that we see inflation, we continue to expect it to move up, maybe not as high as we would have expected it to move up a few months ago. The pass-through of the tariffs into inflation has been slower and smaller. The labor market has softened. So the case for there being a persistent inflation outbreak is less. And so that's why we think it's time for us really to acknowledge that the risks to the other mandate have grown and that we should move in the direction of neutral. So what will we do? We'll do what we need to do, but we have two mandates and we try to balance them. For a long time, our framework says that when our two goals are in tension, and this is quite an unusual situation, how do we decide what to do? Because our tools can't do two things at once. What we do is we ask which is farther from, how far is each from the goal and how long is it expected to get to the goal? So, and then we think about those things and we see, as I mentioned, our policy had been really skewed toward inflation for a long time, really. Now we see that there's downside risk clearly in the labor market, and so we're moving in the direction of more neutral policy.
How concerned are you about the slowdown in the jobs market for households at home, especially younger Americans struggling to land a job?
So it's an interesting labor market, and obviously we think it's appropriate that we reduce our rates so that we become more neutral, which presumably will be better for the labor market. You see people who are sort of more at the margins, so kids coming out of college and younger people, minorities are having a hard time finding jobs. The overall job finding rate is very, very low. However, the layoff rate is also very low. So you've got a low firing, low hiring environment, and the concern is that if you start to see layoffs, the people who are laid off there won't be a lot of hiring going on. So that could very quickly flow into higher unemployment. In a healthier economy, healthier labor market, there would be jobs for those people. But now the hiring rate is very, very low. So that's been a growing concern over the last few months. And it's one of the reasons why we think it's appropriate that we begin to shift our policy focus toward a more balanced one.
Steve Leisman, CNBC. Mr. Chair, in the past, during rate cuts, you used the word recalibration. And I wonder if you pointedly did not use it this time. And in fact, when you said policy is not on a preset course, did you mean that as sort of the opposite of recalibration? Are we meeting to meeting, data point by data point? Are we in the process here of getting back to neutral? Thank you.
So I think we're in a meeting by meeting situation. We're going to be looking at the data Let me say a word about the SEP really here. So we often point this out. What the SEP is it's an accumulation of the individual projections of 19 people, showing what they believe at a particular moment in time to be the most likely path for the economy and thus the appropriate path for monetary policy as well. And as you know, we don't debate or try to agree on what that is. We just write them down and accumulate them. We do sometimes discuss them. And so we always say we're not on a preset path, and we really mean that. The actual decisions we make are going to be based on the incoming data, the evolving outlook, and the balance of risks at the time the decisions are actually made. So you will have seen that we have 10 participants out of 19 who wrote down 2 or more cuts for the remainder of the year, and 9 who wrote down fewer than, in fact, in a good number of cases, no more cuts. So rather than looking at this as certainty, I would encourage people, as always, to look at the SEP as through the lens of probability. And so there are different possible outcomes and likelihoods rather than this one is certain and this one isn't happening. So that's what I would say.
Thank you for getting to my follow-up question, which was, is the dispersion in the outlook a sign of uncertainty of policy in the meetings to come? Thank you.
It is such an unusual situation. Ordinarily, when the labor market is weak, inflation is low. And when the labor market is really strong, that's when you got to be careful about inflation. So we have a situation where we have two-sided risk. And that means there's no risk-free path. And so it's quite a difficult situation for policymakers. And it's not at all surprising to me that you have a range of views. It's not so much about having different views for the path of the economy, but it's partly that. But it's also partly about what's the right thing to do in light of the tension between the two goals. How do you weight them? How worried are you about one versus the other? And so it's natural. I think it would actually be surprising if you didn't have a pretty wide range of views based, in this kind of highly unusual situation, and we do. So, but we get together, we discuss, we have a great discussion, and then we decide what to do and we act. But you're right that it's a wide dispersion of views, and I think that's understandable.
Powell
and
looks
natural in the
tired.
current situation.
He looks exhausted.
Hi, Victoria Guida with Politico. You've talked a lot about Fed independence and the importance of it over the years, but as markets have questions about what exactly President Trump's intentions are with the Fed, what would you point to as the things they should be watching to determine that the Fed is still making decisions based on the economic outlook rather than political considerations?
Look, it's deeply in our culture to do our work based on the incoming data and never consider anything else. That's just everybody who is at the Fed really feels strongly about that way. So, you'll know it by the way we talk about what we're doing, by the speeches that people give, by the decisions that we make. You'll know that we're just still going to do that. That's all we do. And we don't frame these questions at all or see them in terms of political outcomes. I think when you get to another part of Washington, everything is seen through the lens of, does it help or hurt this political party, this politician? That's the framework. And I think people find it hard to believe that that is not at all the way we think about things at the Fed. We're taking a longer perspective. We're trying to, serve the American people as best we can. So I think you would be able to tell. I don't believe we'll ever get to that place. I would say we're doing our work exactly as we always have now, and they're making their arguments, and we're having a great discussion around these challenging issues. So,
do you see the court case around Lisa Cook as being related to questions of Fed independence?
I see it as a court case that it would be inappropriate for me to comment on.
Classic.
Thanks, Mr. Chairman. Edward Lawrence from Fox Business. So we saw the preliminary benchmark revisions down 911,000. The revisions for June were the first negative revisions we've seen since December of 2020. How can the Fed base important decisions on rate and what to do with the interest rates on data that seems to be, as you've called it in the past, noisy?
So on the QCEW, the revision that we saw was almost exactly what we expected. it was amazing how close the expectation was. So, and the reason for that is, for the last bunch of quarters, there's been almost a predictable overcount. And I think the Bureau of Labor Statistics really does understand this, and they're working hard to fix it. It's got to do, of course, it has something to do with low response rates, but it's also got to do with what's called the birth-death model, because a good amount of job creation happens around new companies and how many go out of business, how many are founded. And it's just really hard. You can't survey for that. You've got to have a model that predicts that. And it's quite difficult to do, especially when the economy is undergoing big changes. So, and they've been working on that and are making progress on it. But the data we get is still well good enough for us to do our work. To the extent we have issues around data right now, it's about low response rates. That's happened all over really. Response rates are just lower to surveys now, both in and out of the government. And it's no great secret. We want higher response rates, and we need those to have, less volatile data. And the way to get that is to make sure that the agencies that collect the data have sufficient resources to drive higher response rates. It's not a complicated problem, but that's what it takes. It's not a mystery. That's what it takes. The other thing I'll say, Edward, is in the case of the job creation, the response rate is quite low for the first month, or lower for the first month. By the time you get to the second or third month, you're still collecting responses for that last month, for that prior month. And you get to the place where the data are much more reliable by the second and certainly the third month. So it's not that we don't get the data, it's just that we get it a little later.
But for the benchmarks, if that holds, it's 51% of the jobs that we thought were there weren't really there. Shows a weaker job market coming into this year. If you had had that information, would it have changed your mind related to where the interest rates should be? Should there have been a cut earlier?
We have to live life looking through the windshield rather than the rearview mirror, as you know. And all I can tell you is we see where we are now, and we take appropriate action, and we took that appropriate action today.
Thanks, Howard Schneider with Reuters. So as you mentioned a minute ago, some margins of the job market would suggest that the slide's already happening. A black unemployment rate in August was above 7%, declining work week, difficulty among college graduates finding work, rising youth unemployment. Why do you think a 0.25 percentage point now is going to arrest that?
Well, I didn't say that I thought a 0.25 point would make a huge difference to the economy, but you've got to look at the whole path of rates, right? And markets has already been baking in expectations. I mean, our market works through expectations, right? So I think our policy path really does matter. And I think it's important that we use our tools to support the labor market when we do see signs like that. I did mention that, you see minorities, unemployment going up, you see younger people who are more vulnerable economically, more susceptible to economic cycles. That's one of the reasons, in addition to just overall lower payroll job creation, that shows you that at the margin, the labor market is weakening. I would also point to labor force participation. Some part of the significant decline in labor force participation over the last year has probably been cyclical in nature rather than just the usual aging process. So we put all this together, and we see that the labor market is softening, and we don't need it to soften anymore, don't want it to. So we use our tools, and it starts with a 25 basis point rate cut, but the market's also pricing in a rate path. I'm not blessing what the market's doing at all. I'm just saying it's not just one action.
As a follow-up to that, the growth mix right now seems very concentrated in investment and on the consumer spending side in the higher income groups. Do you feel that that's an unsustainable mix for the economy moving forward?
I wouldn't say that. I mean, you're right. Those are two. We're getting unusually large amounts of economic activity through the AI build out and corporate investment. I don't know how long that will go on. No one does. In terms of spending, you saw that the consumer spending numbers were well above expectations, and that may well be skewed toward higher earning consumers. There's a lot of anecdotal evidence to suggest that. Nonetheless, it's spending. So, I mean, I think the economy is moving along. Economic growth is going to be 1.5% or better this year, maybe a little better. forecasts have been coming up, as you can see. So labor market unemployment is low, but downside risks, but it's still a low unemployment rate. So that's how we see it.
Hi, Stephanie Rule, MSNBC. Treasury Secretary Scott Bessent has said that the Federal Reserve suffers from mission creep and institutional bloat. He's now calling for an independent review. Would you support an independent review, or are you open to any sort of reform in any areas of the Fed?
I, of course, am not going to comment on anything the Secretary says or really any other officer says. So in terms of reform at the Fed, we just went through a lengthy and I think very successful process of updating our monetary policy framework. I would say there's a lot of work going on behind the scenes around the assets we have in the Federal Reserve Federal Reserve System and at the board. Are they the right size? We're actually going through a 10% headcount reduction through the whole Fed, including the board and all the reserve banks. The employment at the Fed at the end of that will be basically at the same level it was more than 10 years ago. So we will have had zero job growth for more than a decade when we're finished with that, and I think we'll probably do more than that. So I think we're certainly open to constructive criticism and.
What a stupid question. Nobody cares. I'm sorry, but I have to say it. But just to respond to what he said about the unemployment has been a big struggle, and it's a lagging data. So we're not seeing what's going on in September until next month. So
on whether AI is already starting to affect the labor market in terms of lower labor demand, higher productivity by contrast. Do you buy that? And if that is true, does that have implications for the monetary policy setting?
So there's great uncertainty around that. I think my view, which is also a bit of a guess, but widely shared, I think, is that you are seeing some effects, but it's not the main thing driving it. And so particular focus on young people coming out of college. And yeah, there may be something there. It may be that companies or other institutions that have been hiring younger people right out of college are able to use AI more than they had in the past. That may be part of the story. It's also part of the story, though, that job creation more broadly has slowed down.
Gen Z is swapping over to trade schools more than any other generations before. I mean, I applaud them for doing that because you could literally be a plumber and make over 6 figures. So you're like, why should we even go to college and take out 6 figures in student loan debt when I could just do that and make 6 figures, right? So.
Well, if you can take goods, just sort of the broad goods category. And last year, goods inflation was negative. If you go back 25 years, that was the typical thing, was that goods inflation was, goods prices generally went down, even adjusting for quality. So that was not the case during the pandemic, of course. Goods inflation went very high, but we had essentially returned to zero or slightly negative inflation. Now, I think goods inflation over the course of the past year is 1.2%. Which doesn't sound like a lot, but it's a big change. So we think, I mean, analysts have different views, but we think it's contributing, 0.3 or 0.4, something like that, to the current core PCE inflation reading, which is 2.9%. So it's contributing. What seems to be happening is that, the tariffs are mostly not being paid by exporters, mostly being paid by really the companies that sit between the exporter and the consumer. So if you buy something and you sell it through retail or you use it to make a product, you're probably taking a lot of those costs on and not able to pass it fully along to the consumer yet. That appears to be what we're seeing. All of those companies and entities in the middle, they'll tell you that they have every intention of passing that through in time, but they're not doing that now. To the consumer, the pass-through has been pretty small. It's been slower and smaller than we thought. But the evidence is it's very clear that there's some pass-through.
I also wanted to ask if you could share with us the conditions under which you might consider leaving the Fed in May.
I have nothing new on that for you today.
Nice.
Hi, Katerina Saraiva with Bloomberg News. I just wanted to follow up on one of your answers just a couple minutes ago. We've often heard you talk about how you and your colleagues, do not think about politics. This does not enter the room. But one of your new colleagues does come from this world, right, where everything is seen through this framework of politics and of what party is being helped, and that person is still employed by the White House. How can markets and the public interpret, some of his speeches, for example, and then some of, the forecasts that we see today? I mean, the median for this year was moved because of the introduction of his forecast. I'm talking about the number of rate cuts seen this year. What do you say to markets and the public that are trying to interpret, what you guys are saying?
So there's 12 vote, 19 participants of whom 12 vote, as you know, on a rotating basis. So no one voter, can really, the only way for any voter to really move things around is to be incredibly persuasive. And the only way to do that in the context in which we work is to make really strong arguments based on the data and one's understanding of the economy. That's really all that matters. And that's how it's going to work. And I think that is the way the institution, that's in the DNA of the institution. That's not going to change.
And then I wanted to ask about a Gallup poll that showed that Americans now have more confidence in the president than the Federal Reserve when it comes to doing what's right for the economy. Why do you think that is? And what's your response? What's your message to the public?
Our response is we're going to do everything we can to use our tools to achieve the goals that Congress has given us. And we're not going to get distracted by anything. So I think that's what we're going to do. We're just going to keep doing our jobs.
Claire Jones, Financial Times. Given the range of views expressed prior to the meeting, I think there was a lot less dissent today than a lot of people expected. It'd be good to know just what you think the drivers were of coming to that very strong consensus in the meeting, and also on the flip side to just explain why the dot plots are really so scattered between, someone even expecting rates to end up higher by the end of the year to 5 cuts. I mean, what were the kind of range of views you had about, on one side, why there was so much support for a cut today, and on the flip side, why there's so much divergence about what comes next?
So I think there's quite a wide assessment that the situation has changed with respect to the labor market. Whereas we could still say, and did say in July, at the time of the July meeting, that the labor market was in solid condition, and we could point to 150,000 jobs per month and many other things. I think that the new data that we've had, and it's not just payrolls, it's other things as well, suggests that there really is meaningful downside risk. I said there was downside risk then, but I think that downside risk is now a reality, and there's clearly more downside risk. So I think that's broadly accepted. And so that meant different things for different people. Some wrote down, almost everyone wrote down, supported this cut. And some supported more cuts and some didn't, as you will see from the dot plot. So that's just the way it is. I mean, people have, you have people who take this work very seriously, think about it all the time, do their work, discuss it with our colleagues. We endlessly discuss this between ourselves, and then we have a meeting where we put it all out on the table, and this is what you get. And you're right, there's a range of views in the dots, and I think that's, like I said, very unsurprising given the quite unusual, historically unusual nature of the challenges that we face. But let's remember, though, the unemployment rate's 4.3%. The economy's growing at 1.5%. So it's not a bad economy or anything like that. We've seen much more challenging economic times. But from a policy standpoint, the standpoint of what we're trying to accomplish, it's challenging to know what to do. There are, as I mentioned earlier, there are no risk-free paths now. It's not incredibly obvious what to do. So we have to keep our eye on inflation. At the same time, we cannot ignore and must keep our eye on maximum employment, which is those are our two equal goals. And you will see that there's a range of views on what to do. Nonetheless, we came together today at the meeting and acted with a high degree of unity.
Archie.
Thank you, Archie Hall from The Economist. You mentioned earlier that job creation was running below your guess at its break-even rate. I'd be curious to hear a bit more about that and where you think the break-even rate is.
So there are many different ways to calculate it, and none of them is perfect. But it's clearly come way down. You could say it's somewhere between 0 and 50,000, and you'd be right or wrong. I mean, there's just many different ways to do it. So wherever it was, 150,000, 200,000 a few months ago, it's come down quite significantly, and that's because a very lower amount of people are joining the labor force. The labor force really not growing much at this point, and that's a lot of where the supply of labor was coming from over the last 2 or 3 years. So we're not getting that now. We've got much lower demand. It's interesting that supply and demand have really come down together so far, except now we do have unemployment ticking up just one tick outside of the range where it's been for a year. 4.3% is still a low level, but I think this speedy decline in both supply and demand has certainly gotten everyone's attention.
I'll follow up if I may. You mentioned the downside risk to employment a fair amount, but it's striking that measures of kind of activity and output for the third quarter, those that we have, seem pretty strong. The Atlanta Fed's GDP now is very strong. You mentioned strong PCE numbers as well. How do you square those things? Is there a chance actually could be upside risk to the labor market if those activity measures are right?
Well, that would be great. We'd love that to happen. So I don't know that you see a big tension there, but it's gratifying to see that economic activity is holding in, and it's a good bit from consumption. It looks like consumption was stronger than expected, what we got earlier this week, I guess. And also we're getting a fairly narrow sector is producing a lot of economic activity, which is the AI build out and business investment. So. We watch all of it, and I would say we did move up. The median for growth for this year actually moved up in the SEP between the June and September SEPs. So, and really the inflation and labor market didn't change much. It's really the risks that we're seeing to the labor market that were the focus of today's decision.
Nicole.
Hi, Nicole Goodkind with Barron's. Thank you for taking my question. Given the cumulative impact of high interest rates on the housing sector, I'm wondering how concerned you are that current rate levels are exacerbating housing affordability issues and potentially hindering household formation and wealth accumulation for a segment of the population?
Housing is an interest-sensitive activity, so it's at the very center of monetary policy. When the pandemic hit and we cut rates to zero, the housing companies were incredibly grateful, and it was really, they said that was the only thing that kept them going, was that we cut so aggressively and provided credit and things like that, and they were able to finance because we did that. The other side of that is when inflation gets high and we raise rates, and you're right, it does burden the housing industry, and so rates have come down a bit, and as that happens, we don't set mortgage rates, but our policy rate changes do tend to affect mortgage rates, and that has been happening, and that'll of course raise demand. Lower borrowing rates for builders will help will help supply, and so some of that should happen. I think most analysts think that it would have to be pretty big changes for it to matter a lot big changes in rates to matter a lot for the housing sector. And the other thing is by achieving maximum employment and price stability, that's a strong economy. That's a good economy for housing. And then the last thing I'll say is, there's a deeper problem here. There's not a cyclical problem that the Fed can address, and that just is a pretty much nationwide housing shortage. Or a lot of places in the country just don't have enough enough housing for people, and all of the areas around metropolitan areas like Washington, for example, are very built up, and so you're having to build farther and farther out, and so that's where it is.
And just a quick follow-up, during the last SEP, or the press conference following the last SEP, you seemed to indicate that policymakers lacked conviction about their projections, and I'm wondering if you still feel that way.
Forecasting is very difficult even in placid times, and as I've mentioned before, forecasters are a humble lot with much to be humble about. So I think right now is a particularly challenging time, even more uncertain than usual. And so I don't know any forecaster anywhere, really. Ask any of the forecasters whether they have great confidence in their forecast right now. I think they'll honestly say no.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. If you're cutting rates, why continue to reduce the size of your balance sheet, then pause the unwinding?
Well, I think we're cutting the size of our balance sheet quite marginally now. As you know, with the balance sheet, we're still in an abundant reserves condition, and we've said that we would stop somewhat above somewhat above an ample reserves level. That's where we are, and we're getting closer to that. We're monitoring it very carefully. We don't think that has at all significant macroeconomic effects. These are pretty small numbers moving around inside a giant economy. The level of runoff is not very large, so I wouldn't attribute macroeconomic consequences to that at this point.
And at his recent confirmation hearing, Stephen Myron brought up that the Fed actually has 3 mandates from Congress, not just jobs and stable prices, but also moderate long-term interest rates. So what does Congress mean by moderate long-term interest rates? How should we understand that when we see the 10-year Treasury moving? And how do you think about this part of the mandate when policy choices like rate cuts or balance sheet reductions affect the long end of the yield curve?
So, we always think of it as the dual mandate, maximum employment and price stability, for a long time, because we think moderate long-term interest rates are something that will result from stable inflation, low and stable inflation, and maximum employment. So we haven't thought about that for a very long time as a third mandate that requires independent action. So that's where that is. And there's no thought of, as far as I'm concerned, there's no thought of considering that, considering that we somehow incorporate that in as something in a different way.
Thanks, Chair Powell. Matt Egan from CNN. We recently learned that average FICO credit scores are down this year by 2 points, the most since 2009 during the Great Recession, and delinquencies are high for car loans, personal loans, credit cards. How concerned, if at all, are you about the health of consumer finances, and do you expect today's cut will help?
So, we're aware of that. I think this default rates have been kind of ticking up, and we do watch that. They're not at a level, I don't believe they're at a level where overall they're terribly concerning, but it is something that we watch. Lower rates should support economic activity. I don't know that one rate cut will have, a visible effect on that, but over time, a strong economy with a strong labor market is what we're aiming for, and stable prices. So that should help.
Just to follow up, this rate cut is coming at a time when the stock market is at or near all-time highs, and some valuation metrics are elevated historically. Is there a risk that cutting rates could overheat financial markets, potentially fueling a bubble?
We're tightly focused on our goals, right? And our goals are maximum employment and price stability. And so we take the actions that we take with an eye on those goals. Separately, and that's why we did what we did today. Separately, we monitor financial stability very, very carefully. And, I would say it's a mixed picture, but households are in good shape. Banks are in good shape. Overall, households are still in good shape in the aggregate. And I know that people at the lower end of the income spectrum are under pressure, obviously. But from a financial stability perspective, we monitor that picture. we don't have a view that there's a right or wrong level of asset prices for any particular financial asset, but we monitor the whole picture, really looking for structural vulnerabilities. And I would say those are not elevated right now.
Jean, we'll go to you for the last question.
Last question. All right.
Hi, Chair Powell. Jean Young with M&I Market News. I wanted to ask about inflation expectations. You've said the Fed can't take the stability of inflation expectations for granted. You mentioned at the short run, they've gone up a little bit. I wonder if you can talk a bit about that. And then also at the long run, wondering, do you see evidence that the debate over Fed independence and the growing deficit is putting pressure on inflation expectations?
So as you said, shorter term inflation expectations have tended to respond to near term inflation. So if inflation goes up, inflation expectations will predict that it takes just a little while to get back down. Fortunately, throughout this period, longer term inflation expectations both break even in the markets, and almost all of the longer term surveys, Michigan being a bit of an outlier lately, have been just rock solid in terms of running at levels that are consistent with 2% inflation over time. So we don't take that for granted. We actually assume that our actions have a real effect on that, and that we need to continually show and also discuss our commitment to 2% inflation. And so you'll hear us doing that. But we're, as I mentioned, it's a difficult situation because we have risks that are both affecting the labor market and inflation. Those are our two goals, and so we have to balance those two. When they're both at risk, we have to balance them, and that's really what we're trying to do. Your latter part of your question was about independence. I don't see market participants. I don't see that that's something they're factoring in right now in terms of setting interest rates. Thanks very much.
Okay, that was the end of
that wraps up the news conference.
The press conference by Jerome Powell. So a lot of things that was said, and the next data that's coming out, if you're just tuning in and if you missed the first part of the live stream, and I did talk about what the next the data indicators that the Federal Reserve is looking for. So we got the JOLTS coming out September 30th, which is 2 weeks from now. We got unemployment data coming out on October 3rd. If you want to mark them down on the calendar or whatever, get a notification. Or you can always come to my private group at firesidechat.com/community, and you always get an alert on that. And then we're going to get the next Federal Reserve meeting on October 29th, and I'm going to be live streaming for that too. And then we're going to get a better idea of how that unemployment is going. So something else that they didn't mention is that the federal employees, the unemployment rate is it's been rising in that sector alone, in the government sector, because a lot of people have taken DRPs, early retirement, and they're looking to separate either at the end of this year, December 31st or September 30th, just depending on which one they took. But if they don't find a new job, or say in the private sector, they stay unemployed, or they just completely retired, or let's just say that they did separate, I would say that the unemployment rate could continue to rise when we get the October data for September. And then we want to see how it goes for November going into to October. However, employment does slightly get better during the seasonal for seasonal workers, because if you think about places like Target, Walmart, they're going to start hiring a bunch of seasonal workers in October, November, December for the holiday shopping. So you could see that unemployment possibly declining during those months. However, the leisure and hospitality, and I'm in Vegas, if you didn't know that, I live in Vegas. So the Strip has been slow lately. And I don't know if you guys have seen that headline, but I mean, it's still somewhat busy, but it's just not as busy as it used to be. And some casinos are losing money, right? So they're trying to figure out like a way to bring more people into Vegas, because if you look at any hospitality sector, you want to look at Vegas first. We have less tourism now, and we have fewer people coming to Vegas to visit due to policies, whatever economic concerns. But the Vegas economy is, and even the housing market has been the prices have been dropping the steepest out of all the housing markets in the country. So that is an interesting portion of it. And the hospitality sector, leisure and hospitality, is declining the fastest, and that's always a sign of a I'm not going to say recession, but it's more like a very like a slowdown in labor demand, right? And people lose their jobs because why? When there's a unemployment rising, what do people do? They hold on to their jobs and they cut off their what? Discretionary spending, right? They're not going to travel as much as they used to. They're not going to eat out as much as they used to. They're not going to travel to Vegas or go see the Raiders game, whatever, right? And that's just how economy works. But here's the thing, though. The CPI inflation, just from what I gather, all the inflation data right now, yeah, they're going to come out October 15th, 16th for CPI. PC inflation comes out September 26th, which is 9 days from now. It's all going to be about the labor market right now. That's going to be their focus. And until the October 29th meeting, that's going to be the focus, is what the unemployment and the jolts are going to look like going into it. And I know there are some stupid questions in the crowd, and I'm just like, that's pretty dumb. Like, nobody cares. And I'm trying to, in my channel, I'm always politically neutral. And somebody in the private comments, in the private group, they're like, well, Psy is always leaning whatever side, right? And I'm like, no, I don't. I really don't. I never voice whatever, like, support for whoever, left, right, middle, whatever. I'm like neutral. And I remember when I criticized the Secure Act 2.0 during the Biden administration, and people were commenting on my channel saying that, oh, this guy must be MAGA or whatever. I'm like, really? Because I disagree with some policies, that makes me automatically on the opposite side? And if I criticize the big beautiful bill, which I have, that makes me a left. I'm like, whatever. That's really not the point. But anyway, it's just something that we want to pay attention to going forward. Is he already said, Jerome Powell already said that he's nobody in not even one committee member, if I recall, is interested or has voiced a jumbo rate cut of 50 basis points, right? So just 25 basis points. So as of right now, per the report, it will be 25 basis points at the next meeting, 25 basis points in December. It will be data dependent. So we'll see how it goes between now and October 29th. And then the last meeting of 2025 will be on December 10th. And then we're going to get the December version of the summary of economic projections. And that one is going to give us a better outlook on how many rate cuts they're looking to do in 2026. That's going to be interesting because Jerome Powell is not going to be the chairman after May 2026. So they're going to, Trump is going to appoint someone else to be the chairman. And one of the questions that one of the reporters had was, are you going to remain a Fed? Because once he steps down from being the chairman, he can still be the Fed, right? He can still be a committee member. He can still vote on the policies, the monetary policy. He's still going to be a part of it. Or is he going to retire completely, and that's going to create a separate spot? So that's going to be something very interesting to see. Next year, they're going to, during the Federal Reserve meeting, and then his last one should be for May 2026. That will be the last press conference, and I'm going to be live streaming every single time he comes on. But yeah, rate cut today, and the market is flat. If I had to guess, it's very confusing based on what he said. Are we cutting? So he mentioned that the labor market is showing weaknesses, right? So there's a recession fear, and nobody's NBER is supposed to be the one declaring the recession, and that hasn't happened yet. But the growth has slowed down, but inflation is still high. But at the same time, the labor market is also slowing down, and unemployment is going up. So there's a fear of a possible recession going forward. But there's another term for that, with inflation sky high, that would be stagflation, right? So back in the 1970s, that happened. And a lot of people are saying that that's already happening now. But yeah, anyway, that was a good live stream, 2 hours. And I got to meet with some clients. And you can always go to firesidechat.com/consultation if you want to talk about your FIRE journey, your debts, your how you want to plan for your early retirement, that kind of thing. But check it out. And we do have the private client program. Go to firesidechat.com/private clients. And you can always, you have to schedule a 60-minute consultation before joining the private client program, because you may not be, that may not be suitable for you, just really depending on what's going on with you. All right. Anyway, really appreciate you guys being here. And I will be back on Tuesday for the live stream next week to talk about the Roth IRA Q&A. So come on back next week and ask some questions. That's all going to be Q&As. All right. Anyway, until next time.